Hi, my name is Reed Silverne. The name of this show is Fed Pride. Reason it's called Fed Pride is because I'm a federal worker, retired, and proud of it. Today, for me, this is more complicated than it used to be. Today, for me, it's the April 17th. For you, it's probably going to be Tuesday, April 18th, or Thursday, April 20th. However, now I only tape every other week. This is live to tape, which means if I fall off my chair, you're going to see me fall off my chair. If I end up with dead air because I made a mistake, you're going to see that too, and it just happened last time I was on. So potential for mistakes is almost infinite because I am my own engineer, and to prove it, I'm going to disappear myself and reappear myself. So I'm basically the guy in charge of all the buttons. However, I have to thank the folks over at Access Tucson because they set up my shot and they take care of me, and they do a wonderful job over here. So that's basically it in a nutshell, and good luck to Access. I hope it lasts for another 20 years. I believe it just had its 20th anniversary, and I think it's just a great service. If anybody has a thing to say and wants to get it out and wants to say it, I strongly suggest that they come down to Access, sign up, you take a few classes, and then you enter a lottery and you can get your own show. So I think it's a great service, and I'm glad that they fill a lot of content. A lot of content that's probably a lot more interesting than mine. So, again, as I said, I'm now on Tuesdays at 7 o'clock, Thursdays at 4 o'clock. And the good news for those in Northwest, and I live in Northwest, a lot of people only get Channel 74 there. I'm on Channel 74 in the Northwest on Thursday at 4. You can get my channels and my information and my whens and my whats off of the Tucson Access website. And I believe that they just did a great job. Going to every other week has been working out just fine for me. And if it makes more room for other people to have shows, I'm more than happy to do it. So that's basically it in a nutshell. Looks like Access is going to be here for a while, and I'm real pleased about that. So I'm going to talk about a few things, some of which might not be that interesting to a lot of people, but of course it's interesting to me. Now, we've gone through a credit crunch back in October of 2008. We are now suffering from the recession that resulted from the credit crunch, and we're just going through a terrible time when unemployment is about 8.6% nationwide, 7.8% right here in Arizona, and a lot of that is due to the legalization, primarily the Commodities Modernization Act of 2000, which I've talked about a lot, that basically legalized derivatives that were in such a form that they were practical fraud, even if they're legalized. As far as I'm concerned, if you are legalizing a process that results in fraud, it's still fraud. And I think a lot of the people that issue these derivatives should be charged with violation of the RICO Act, basically racketeering to steal money from the public, and they did in the tune of hundreds of billions and even trillions of dollars. The whole crisis started in 2006 as a result of basically mortgage-backed derivatives, but just about every financial instrument ended up being taken over by the derivatives thieves. Car loans collapsed, short-term commercial paper collapsed. If the Fed hadn't intervened in August and September of 2008, the entire commercial paper industry completely collapsed and froze up. And what that is all of the inventory loans of all the stores. In short, every store would have gone bankrupt within a month or two and been unable to sell except for giant chains that are self-financing like Walmart. So basically, you wouldn't be able to buy anything except to go to a Walmart. And those that sold to any other company would have lost their sales, and there would have been a Great Depression. That's only one of a number of potential Great Depressions over the last 6 to 8 months that have been prevented. Another one was due to a freezing up of the credit market that resulted when they allowed Lehman Brothers, one of the giant banks, to collapse. Lehman Brothers owned credit swaps, and other companies had credit swaps that were based on Lehman Brothers staying solvent. Basically, a credit swap is a side bet that says, I hold a bond, let's say in Lehman Brothers, and I would lose everything if Lehman Brothers went out of business. Therefore, I take this side bet, which is a credit swap, basically saying that if Lehman Brothers goes out of business, then I get my money back. Now, the main company that supported the market for these, what they called CDSs or credit default swaps, was AIG. And within a few days after Lehman Brothers collapsed, the government and the Paulson, at that time the Secretary of Treasury in the Bush administration, Bernanke, realized that AIG and the entire swaps industry was just about to collapse because everybody who had credit default swaps against Lehman Brothers were about to cash in. And that would have been billions of dollars more than AIG could possibly have in the entire world. In those days, and they still do, they haven't changed the law yet, but they have what they call naked credit default swaps. A naked credit default swap is a credit default swap. In other words, I have a side bet and I own a bond and I'm protecting the value of the bond. That's what a credit default swap is for. And so I'm making a side bet, just like don't pass on the craps table, that if the company I'm holding the bond of goes down, I get my money back. Well, they allowed an entire market in credit default swaps of people that didn't own the bonds in the first place. And that other market, these naked credit default swaps, had a nominal value of $60 trillion. And the regular credit default swaps was another $20 trillion. $80 trillion is more money than there is in the entire earth. It's more value than in all the goods and services in the entire earth. And consequently, that started freezing up, and the government had to go in there and, over a period of 2 or 3 payments, pay AIG $180 billion to cover credit default swaps, because if that market had collapsed, a lot of the derivatives that were out there were based on having credit default swaps as part of the derivative. They would have all gone down to zero on paper, and that would have created an even worse credit crisis. Things were so bad before they passed the TARP in September and October of 2008 that banks would not loan overnight loans to other banks. That meant that if you went to the ATM machine and you wanted to take out $400 out of the ATM machine over at Wells Fargo and you had an account in Bank of America, Wells Fargo would charge Bank of America 4% rather than what's now 0.25% for to support the loan, basically, that it's giving to Bank of America when somebody goes to the Wells Fargo ATM machine, takes money out. So we were that close to the entire financial system freezing up. And it did substantially freeze up. People couldn't get car loans. People couldn't get credit card loans. People couldn't get anything. And worst of all, banks would not only not loan interbank from bank to bank, but they wouldn't loan to businesses, even businesses with historically very, very good credit. So development projects stopped, housing builds stopped, car dealerships went under, the car industry was unable to loan money except out of its own pocket for people to buy cars. Sales of cars went from $17 million a year down to 11 or 12. It was just a calamity. And one of the reasons that occurred is because in response to a scandal the previous decade, the FASB, was the Financial Accounting Standards Board, these obscure little bitty semi-private public organizations that control more than people could possibly imagine. The FASB basically tells all business within the United States how they are supposed to account for their costs, and whether, which is basically how are they making money and how are they saying whether they're making money or losing money. Very, very important thing. And what happened was, and this was because of the Enron situation back in the early 2000s, Enron was creating new markets and then saying that I have a market in internet connections. Every internet connection is worth $1,000, and therefore I have $10 billion that really doesn't exist. The federal government got angry with that, and the financial industry jumped in through this FASB, this organization that makes the rules for accounting, and said, you have to, if you have an asset, if you have a financial instrument, if you have a derivative, if you have a bond, whatever you have to value it at mark to market. Whatever the market will bear for the day. If you have a bond and the market says that bond is worth $100,000, you can say it's $100,000 on your financial statement. If the market says somebody will buy that particular bond only for $1,000, then you have a $999,000 loss. What happened with the derivatives is the derivatives came out there, and it became very, very clear that derivatives, especially pay-through and pass-through derivatives, were worthless. They were worth nothing. Nobody would buy them. The market for them had completely collapsed, and for good reason. Nobody would buy them because they were frauds. They were stupid. Who is going to buy a share in a bond based on mortgages, a pool of mortgages, when they don't even get a share of the mortgages that backs them? It was just a claim on cash flow that nobody knew was going to exist, and some derivative and some credit default swaps that were folded in case the default rate went too high. Basically, the whole idea of it was not only complex, but anybody who actually looked into it and tried to figure out how it worked could see that the whole thing was worthless. It was dumb. Only an idiot would have bought those, except that those idiots were the bankers that support the entire financial system of the world. So when they had to use mark-to-market and the derivative industry collapsed so that there was no market in derivatives at all, if a bank had $1 billion worth of mortgage-backed derivatives at mark-to-market, the market had collapsed. Most they could get that day from that particular derivative is zero. So they lost an entire $1 billion. Now, if a regular company loses $1 billion, they lose $1 billion. However, if a bank loses $1 billion, that's $1 billion out of its liquidity. And there are requirements that if a bank wants to loan $1 billion, it has to be able to put up 5% in capital. It has to have assets worth 5%. In which case, if a bank has $1 billion, they can loan, that would be 5% of the amount they could loan $20 billion. However, if a bank loses $1 billion, then they can not loan $20 billion. And that is the problem with mark-to-market. Mark-to-market is great. It's a good idea. I'm for it. I was for it when they passed it. It was FASB 107. Because I don't think that people should be able to cheat about the value of their financial statement. I think if you say I made $1 billion because I have $21 billion in assets and only $20 billion in liabilities, and what's left over is $1 billion and I'm worth $1 billion, I think that you should be able to say that. But I don't think you should be able to say, I have something, a bunch of derivatives, and I'm just going to say it's worth $21 billion, and I have $20 billion, and I owe $20 billion, so I have $1 billion in net worth. However, that being said, with the banks losing and showing on the books billions and billions of dollars in losses every single month, $5-10 billion, because they had to mark-to-market derivatives that were worthless, that had no market value because nobody in the marketplace would ever be dumb enough to buy these things. That resulted in banks being unable to loan money into the economy. I think at the worst, there was I believe at least $100 billion of losses that were declared in a couple quarters just from the largest banks. And that alone, $100 billion in losses, is $2 trillion that cannot be loaned into the American economy during that same period. So all this came out in September, October, November, right before the election. This collapse kind of, and McCain's reaction to it kind of messed up his candidacy. Obama came in, Obama won, and now he's inherited this entire mess. But behind the scenes, the Congress has been working on a package to re-regulate the financial system, and I certainly hope they do. Among the things that they want to do is they want to just already ban naked credit default swaps. You have to have something to risk in order to make a side bet to protect against the risk. Otherwise, you're just rating companies and so on and so forth. And personally, I don't see any use for naked short selling of stocks either. That's selling stock that not only don't you have, that you don't even want to buy in order to buy back when you make money off of it. Basically, it's selling non-existent stock. And it's the naked short sellers and the naked CDS guys on the bond side that were running the financial sector down to zero, bankrupting the banks at the same time they were being unable to loan, and basically raiding our economy and doing their best to destroy it even faster than it otherwise was. Now we seem to be hitting bottom. One of the reasons we're hitting bottom is the FASB just finally came back and said that for a market that has stopped trading, that banks no longer have to mark to market. And the minute that happened, all of a sudden, Wells Fargo posts I believe it was Wells Fargo, $1.5 billion profit. Well, they have tens of billions of dollars of worthless derivatives. So I don't know how they could possibly have $1.5 billion profit. They also took $5 billion from the federal government. So I think the mark-to-market is already saying, well, now you can say you made $1.5 billion in profit. And by having declared $1.5 billion in profit, that is capital, extra capital you didn't have the previous quarter. Now you can loan $30 billion into the market. Goldman Sachs, I believe, declared a $3 billion profit. That's a company that's taken $10 billion from the government to cover losses. And some of these other banks, Bank of America and so on and so forth, are now all of a sudden coming out of nowhere and declaring profits. And that, of course, has enamored the market, the stock market. The stock market's gone up 26%. I didn't think that it would. So for me, it only went up 20% because I sold at what I thought was the top. But that just shows you if anything happens, don't do what this guy here does. And that's why I don't tell anybody to do anything. But the fact of the matter is that the market has eased up along with the financial sector. Does that mean the economy is getting better? No, the economy is getting worse. There was a month there where housing starts had improved. Now housing starts have collapsed again. 600,000 more people were laid off. There's now 6 million people on the unemployment rolls, pulling down unemployment, where there was only 5 million 2 months ago. Things are getting worse and worse, actually, and not better and better. However, does that mean that things are starting to top out or bottom up or whatever it does when it finally hits bottom and then turns around? I believe yes, a little bit. But I think there's still going to be some bounces back down when the market realizes that people stop spending money. And a lot of these stocks make things that people buy, pool tables and boats and cars and things like that, are still in trouble. We're not out of the woods yet. But I think that we have at least prevented the Great Depression from occurring. Now, another wrinkle on this mark-to-market thing, and I believe that nobody in my audience is probably going to care about this, but in order to try to get these derivatives off the books of the banks so the banks could start loaning again, they developed something called PPIP. And PPIP is the plan of our Secretary of the Treasury, Gertner, and Obama to save the entire financial system. How? By giving loans to hedge funds to buy bad derivatives and get them off the books of the banks. Well, the catch to the FASB thing, which says that the banks don't have to mark to market anymore, is that they do have to mark to market if they actually sell an asset. So what they've done is they basically put an arrow right through the heart of this new system that was supposed to save the economic system by telling the banks that they should not in any way sell these toxic assets, get them off the books, because if they do, then they have to show the loss. And if they don't, they can predict whatever the value ought to be if there was a market for it, which is called mark to model. And of course, anybody who's been following derivative things knows that the models have been terrible. And whoever invents these models, these mathematicians, are terrible financial predictors. They don't do a darn thing, and they create value where there is none. However, in this one case, because we've been in this situation where banks cannot loan, where businesses can't get loans, where businesses that have paid their debts throughout the entire life of the business, run by honest people, are being forced out of business because they can't get inventory, because they can't finance themselves. Hopefully, the mark-to-market rule is going to allow the banks to pretend to be profitable, even if they're losing their shirt and they're losing the people's shirts, even if they're thieves and who knows what else and should be in jail, to allow them to say, I'm making a profit and now I have money that I can legally loan to everybody else, to the honest people in the rest of the economy. So that this little bit of what appears to be fraud, basically saying, I have value, I'm creating value, and I'm saying something has value when it isn't, and that I have an asset that's worthless, but I'm going to say it's worth something, that fiction, credo, I believe, the belief in that is going to help bring back the economy and help these same guys that messed everybody up to loan money to honest businessmen who can hire people and make things and get this economy moving again. Then I'm afraid I'm all for it. My name is Reed Silverne. Name of this show is Fed Pride. I really appreciate your watching, and I'll be on Tuesdays and Thursdays. Thank you very much.